All right, everybody, Ryan Schul here. Welcome to my channel. If you've been here before, then welcome back. So the topic for today is ranking all Dow 30 stocks based on fundamentals. So what is a fundamental? It's things like ROA, ROE, ROI, price to earnings, price to cash flow, price to sales, things like this, like things where we can do a fundamental analysis of financial ratios and try to understand the overall financial health of the company, okay? So some fundamentals are more favorable when they're lower: price to earnings, price to sales, price to book, long-term debt to equity. You want less debt versus equity, right? You want higher book and lower price. You want higher sales and lower price. You want higher earnings and lower price, right? So sometimes if the ratio is lower, it's better. Sometimes it's better when the ratio is higher. So higher next year earnings per sales, higher is better, right? Higher sales overall is better. Higher ROA, ROE, ROI. If these metrics are higher, these can be better, right? So it's not always higher is better. It's not always lower is better. It can flip. It really depends on the fundamental factor that you're looking at, right? So we can measure how not idealistic or how powerful, what's what I'm looking for, how nicely everything is going to work out for the stock, how favorable the stock is going to be for our portfolio. Let me just state it that way, based on z-scores, right? So we can put all the metrics in the same scale, and the z-score will help us to do that. It will help us to normalize or to standardize everything. The only thing we have to remember here is that z-score measures the value minus the mean that we're looking at. So the actual value of the price to earnings, price to sales, price to book, minus the mean of all of those, divided by the standard deviation of all of those, okay? And if lower is better, like for the example of PE, price to sales, price to book, we actually want a negative z-score, okay? So negative z is going to be better, but if higher is better for these metrics, then we want a positive z-score. So it gets a little bit complicated right out of the gate here. I'll admit that, but do some research. Google this if you don't understand it. I think you're going to learn a ton. So let's jump into it. Okay. So I'm going to go ahead and pull in data from this website. It's called Finviz. I've used this in a couple of my videos in the past. I'm a huge fan of this. I like this a lot. If you go over here, I can show you what this thing looks like. Basically, pretty cool the way they aggregate all the data here and quote. Let me see if I can just find it right off the bat. Okay, page not found. That's fine. I think we can go here and look for Apple, AAPL. Enter. Okay, so this is what I'm talking about when I say financial ratios here, okay? Or fundamental ratios, right? So here we have the index, market cap, income, sales is 400 billion, okay? Cash per share, so this is the total cash that the company earns or holds, and it's on its books, divided by the number of shares outstanding. Here's the price to earnings, forward PE, PEG ratio, so price to earnings divided by growth, 3.84, price to sales, price to book, EPS, and over here we have ROA, ROE, ROIC, return on invested capital, short interest, performance year to date. Well, there's a lot of ads popping up. Okay, I can't control this. I can't control it. But so this is going to be the source of the data. So I wouldn't expect you to understand all these. I know a lot of these. I don't know every single one. But do some Googling if you're not familiar with these and get up to speed. I think it's very fascinating and very interesting what all of these fundamental ratios represent. So I'm going to use that as the source for my data. I'm going to hit Control Enter. That does take about 30 seconds to run. So I have a list here with tickers. I have I equals 1 just so I can increment and count what point we're doing the import here, just so I can keep up with it. I know there's about 30 in here. I'm using a user agent headless, okay, or headers as a Mozilla agent to go ahead and do the fetching of the data for me. And here is my my loop for URL and URL list. So you have URL list here. These are all the tickers, right? So TICK or TCKR comes from right here, all right? And we have the base URL, which comes from here. So we're appending each ticker onto that base URL and then fetching the data from that, and then going to the next ticker, doing the append, doing the fetch, and then putting everything into a data list, which exists right here. And when this is done, here's the data list.append, okay? D is the index of the data that we're looking at. And when everything is all done, we convert that to a data frame, and we can go take a look at the data frame right here. So this is it. So we have the index, price of earnings, earnings per share. We have the ticker symbol over here, AXP, AMGN, that's Amgen. This is Apple. This is Boeing, BofA. And here's all of the financial metrics here, right? So Apple, if we look at the PE, I have 30.83. Let me go back here, PE. Let me search for it. PE. 30.82. Okay, I think it's doing a little rounding thing. That's fine. It's fine. EPS, TTM, so trailing 12 months, 6.41. EPS, give me my EPS, please. EPS. TTM 6.41. Okay, and let me just check one more over there. Forward PE. So that's a big one. 25.38. Go here. Forward PE. 25.37. Okay, so I think there's a little rounding issue thing going on here. Either the site isn't representing everything and it's just displayed slightly off by a penny. I wouldn't worry about that. Or this over here is being rounded, but it's close enough for what we're trying to accomplish here. So that's the thing. We go to that website, do the fetch, pull back each ticker with all the fundamental factors over here, or fundamental analysis features over here, append everything into a list and convert the list into a data frame. So we're in a good spot. We can move on here. Next, we'll copy the index to a new data frame and drop the index column. And we're going to do a little cleanup on the data. So if you look close, you can see an M over here that represents millions, 2.06%. So that's okay, you know, when we're looking at it. Well, when we want to do some real analysis, that is not going to work for the computer. The computer doesn't know what percents are. It doesn't know what M's are. I think I saw some B's over here. B represents a billion. Okay, so there's a B, but it doesn't know what these numbers are, right? So we have to tell it, just chop those off, cut those off, because when we do some analytic work on these features, the computer isn't going to be able to handle it and it's going to crash, right? So we do a little data refinement, a little data cleaning. One more thing I want to do over here is look at the columns in data frame, because I noticed not all the columns come in with actual data. Sometimes you'll have a column name and everything in the whole column is all zeros. So I'm only looking at 30 different tickers here. So presumably, you know, if you go outside of this universe of 30, if you go to a much bigger universe, then the column will probably be populated with something. I don't think it makes sense to have a column with no data. But in some cases, it just doesn't have anything for these tickers, right? So we have 76 columns. If I drop any column that has all zeros, because the zero is not going to add any value to the analysis whatsoever, then I end up with 68, right? So I'm printing the DF shape over here, dropping anything that contains all zeros, right? And I end up with 68 columns. So it looks like we lost 6 plus 2. It looks like we lost 8 columns, but no biggie, okay? We still have what we need. So I'm going to hit Control Enter here. I built a small dictionary of factors. So this has price to earnings, earnings per share next year, sales, price to book, ROA, ROE, ROIC, and long-term debt to equity. Now remember, some of these, we want these to be low. We want low price to earnings because it means the denominator is bigger and the numerator is smaller. So overall, the ratio is going to be lower, right? So we want a lower price, higher earnings. That's going to be a better fundamental factor for all of these stocks across the board, okay? If your earnings, not the earnings, if the price is lower and the earnings is higher, that's more desirable, right? Same thing for price to sales. If the price is lower and sales is higher, that's good. Price to book, price is lower, book is higher, that's good. ROA is return on assets. So we want ROA to be higher, right? We want higher return on our assets. Same for ROE, the return on the equity of the company. We want that to be higher. Remember, the company is comprised of assets plus liabilities, or assets minus liabilities plus owner's equity, right? So we want higher equity, higher return on the equity, or higher return, right? So that is a feature that we want to look for that is going to be higher, okay? So I'm going to go ahead and use my z-score methodology over here, okay? So I have standard scaler. I'm taking all of this and scaling it. My factors are basically this data frame. If I hit Control F to search, you'll see the factors go over here. I'm using a scaler over here. If I do Control F over here, the scalar is used to help me get all the z-scores, okay? So I'm looking at all of the data frames selected. If I go over here, this is coming from here. These are all the factors, right? So you can see how this builds. It kind of cascades down from one level to another. Then I can go ahead and calculate all my z-scores, and I can create a composite score and then rank all of these composite scores. So that is the ultimate goal over here, okay? So created the dictionary after doing the cleaning. Remember, we had to do the cleaning. We're standardizing everything and then creating z-scores based on that, okay? So again, wait, what did I say originally? Lower gets a negative z-score, right? And yes, and higher, we want to see a positive z-score, okay? So I think that is in good shape. So let me see, I just ran it. Okay, I ran it. I got the composite score, and I'm doing a ranking based on the composite score, right? So we have dot rank right here, and I'm assigning that to this column. And the composite score comes from z-scores. Z-scores comes from over here, okay? So it's a little convoluted, but just try to bear with it. I think the payoff is going to be huge here, okay? So we have the original data frame with all the tickers over here, Apple, United Healthcare, down to Amgen, right? And we have all the original fundamental features over here. So I created two new columns called composite score and rank. So I want to see what this composite score looks like. So a higher composite score equals a higher rank. So this is actually number 1, 2, 3. We go down to 29. Okay, I might have missed one. So I know there's 30 in the Dow, or there's supposed to be. There's not always 30. They could have dropped one. There could be 30, 31. There could be 29, but most of the time I think it is 30. So I might have dropped one. No biggie. We got the ranks. We got the composite scores. So higher composite score is better. Lower ranking is better. Lower composite score is worse, and that deserves a lower ranking. Okay, so I'm going to go ahead and pull in data from Yahoo Finance. So I want this time series data. Remember, we got the fundamental data that has all the fundamental features in it, but it doesn't have any kind of pricing information built in, right? So we have to get pricing information from Yahoo Finance. Okay. So let me go down here. So we have price data here, and we're going to calculate returns. Okay, so returns based on price data columns, and price data comes from here. So this is why I love Python so much. So price data, 1 month return is literally just price data dot percent change 21. So it's 21 days on average in a trading month. There is about 63 trading days because you have to subtract out the weekends, right? And we have about 11 non-open exchange holidays, right? So the exchange is closed for Christmas, for New Year's Day, I think for Memorial Day, 4th of July, Thanksgiving, and there's a few others. Labor Day, Memorial Day, they say those. I think those are the main ones, and there's a handful of others. Maybe President's Day, it's close. So on average, it's 30 days in a month, but for trading days, we're looking at 21. In 3 months, it's around 363. 6 months, 126, and in 12 months, about 252. Obviously, there's 365 days in a year, but you have to subtract out every Saturday and Sunday, plus those 11 non-open, non-trading days, right? So we can go ahead and get the returns. So very efficient. One line of Python script will give us the returns for 12 months. And we have the 1, 3, 6, and 12 right here. So these are the returns for all of our stocks. So this looks fine. We're going to go ahead and match returns with a composite score and the ranking that we did previously, right? So remember getting the composite score from the z-score, and then the rank was based on the composite source. So we ranked the composite score in descending order. So this is what everything looks like when we join it together. Okay, so we have composite score and ranking, and then we have the 1 month return, 3 month, 6 and 12 month return. So Apple seems to be the best pick, and these are the historical returns for that stock. Down here, Amgen came in dead last. This was ranked 29th, negative 6.76 for composite score, and the returns are actually positive So at the beginning, like when I was looking at this, I had to think about it. Why would we have some negative returns over here and get a higher composite score and higher ranking and have a few positive returns over here, but this is ranked last, right? Let me get to that in just a minute. Let me get just a truncated view here. So it's a lot to look at. We're looking at 29 stocks. If I just pick the top 10, it's not even 10 because we don't have 10 that make the cut, but I can apply a filter and get rank less than 10. Remember, the higher the better. So I'm looking at the top 10 here. There's actually only 4 that meet this criteria. 3-month return greater than 0 and 6-month return greater than 0, right? So this gets kicked out. Apple gets kicked out because the 3-month return is not greater than 0. All right, if I change it a little bit to -1 or something, and that to -1, would probably get, probably get all 10. Let me see. Yeah, I think we got all 10 there. So, but I really want to apply a filter to show me really the true top stocks, right? So if we have negative returns, it just doesn't seem like it's a good investment. But why do we get negative returns and we get like the high quality ranking, but the company doesn't seem to be performing well? Basically, Apple is ranked number 1 fundamentally, so all the fundamental features add up to a number 1 ranking, but its recent return is actually negative, which might indicate that the market hasn't responded yet to the positive fundamental factors, right? So the market could have a lag, there could be inefficiencies, there could be other factors at play here that are pushing down the returns for Apple, right? We're just looking at fundamental factors and we're looking at basically technical factors because we're looking at price changes over time. So we're looking at both fundamentals and technical, but maybe the market hasn't picked up on the better fundamentals. Maybe there's other features here that are pushing down the stock price, slumping sales. Maybe overseas, there's some issue with some manufacturing plant. I believe most of the phones are made in China. Maybe there's some turmoil or unrest in China that the market has picked up on. That's not in our data set here, right? So we're not analyzing everything in the universe. We're looking at some fundamentals and some technicals, right? But not every single thing is here. So valuation-based strategies take time, and value stocks often underperform before they revert. So Apple could be an excellent opportunity. It seems like for the past 12 months, every one of the periods we looked at, 1, 3, 6, and 12 months, the stock was down. But again, excellent fundamentals. So maybe this is a good pick for a stock that is about to pop and generate some serious capital returns here. So let me look at the composite score versus 12-month return over time and plot everything together. I always say a picture is worth 1,000 words, right? So if we can look at the whole universe of stocks and see how everything plays against everything else, you can see the 12-month return is actually negative, and the composite score goes from about -6 to 4, right? So here's Apple, that's the highest. Amgen was the lowest. We saw that before. And based on 12-month return, IBM was actually the highest, and UNH was the lowest. So -36%, IBM was up 71%. Wow, that's a lot, actually. So if we go over here, IBM, where's my IBM? Yeah, 71%. We can see that. And what was Amgen? No, UNH. I think it was UNH that we saw. And UNH is over here down 36%. Okay, just so we can comprehensively look at everything all in one spot, all at the same time. So now I want to look at momentum score and then total score. So I'm going to hit Control Enter and take the mean of 1 month, 3 month, and 6-month returns. Just take the average of those 3 to get the momentum score. So is the momentum of the stock trending up? Is it trending down? Is it not moving at all? Here's the momentum score. It's slightly negative. This is negative. This is positive 14, positive just slightly, and negative 0.08. So now we can assign a total score here based on the composite score and the momentum score. So remember, the composite score is the first thing we calculated based on z-score. Then we ranked all those composite scores. That's how we got the rank. We just calculated the momentum score to see is the stock price trending up or is it trending down over time. And we're adding the momentum score and the composite score to get a total score over here. So I think we're in good shape. We are about 2/3 done. Hang with me here. So now we're joining the returns with the DF ranked. So DF ranked was one of the data frames that we used back towards the beginning, and the returns was one of the data frames that we got from Yahoo Finance. We're calculating all the returns over time. Okay, I'm just looking at the returns, not really doing a whole lot right there. I want to see what the correlation between the 12-month return, between all 12-month returns and all the fundamental factors that we're looking at. So a 12-month return is correlated to itself perfectly, right? Whenever you look at a correlation, anything against itself is going to be perfect. So performance for the year has a very high correlation to the 12-month return, right? So that should make sense. If you're looking at 12-month return and performance for the year, they should be almost the same thing, right? So 52-week high, so high correlation. So now we're starting to see patterns here, like what features are actually really driving the 12-month return, right? So originally we looked at things like price of earnings, price of sales, price of book, ROA, ROE, things like this. But actually what's driving the 12-month return is very different than what I initially thought it was going to be, right? So that's why we have to do different types of analysis and come at this from a different perspective sometimes, just to understand like comprehensively what's going on. So let's create a heat map of this correlation plot just to visually see where the highest correlations are. So anything dark blue is going to have a high correlation. So performance for the month is going to be highly correlated with which ones are we looking at? The 1 month, 3, 6, and 12. So it makes sense, right? Performance for the month and performance for the quarter. Again, quarter and 3-month return, almost the same thing. So anything dark blue, you'll see that you'll have a high correlation. Performance for the half year, right? And this one for the year. So high correlations. So if you have a dark red, it's high negative correlation. Okay, so price to free cash flow and EPS past 5 years has negative correlations. We see kind of a larger negative correlation here, ROA, negative correlation. So let's do something a little bit more sophisticated and apply some machine learning to try to solve this problem. Again, which features have the highest importance in terms of statistical influence on the target variable. So I have several videos on my channel here describing the X and Y variable. The X is independent, the Y is dependent. We're using these independent variables to try to predict the dependent variable. So I want to know of these independent variables right here, which has the highest statistical impact on the target, which is the Y variable. So we're going to look at the importance of each of these features in terms of driving that target variable. So performance for the year was number 1, 52-week high is number 2, insider transactions, 0.2, so 2% performance for the quarter, PEG ratio, so that's price to earnings growth, and then they kind of get smaller and smaller over here. So if it has a really small influence, I'm not too concerned about that. It really has almost no impact. So here is a plot of the same thing, 0.692 performance for the year. That's exactly what we see here. And the next largest was 0.11, 52-week high. That's what we see here. So we're in good shape. The next thing I want to look at is rebuilding a composite score using only these predictive features. So originally we used totally different features like ROA, ROE, ROI. But let's look at these features because this ML model is telling us these are the top predictors for that we should consider for the composite index, right? So again, refined rank. Did I spell that wrong? Refined rank. Where's error exactly? Okay, bear with me here. Display correlations for refined rank. I'm calculating the refined rank, right? So that should be fine. Maybe I misspelled it. I don't see it though. Right, try it again. So I will just do this. I'll just go to my eyes are getting worse and worse as I get old. I have to get glasses pretty soon. So maybe there was a misspelling there. I didn't see that, but it's the only thing I can think of because everything else looks totally fine. So, okay, anyways, we have the refined composite score based on these independent features, right? These independent fundamental features. And we have a refined composite score. And we're based on that, we're assigning rank again, dot rank, and creating a refined rank. So if we go over to the side, we can see what the results are. So this was the original composite score, original rank, refined composite score, refined rank, right? So everything looks fine. It looks like we're doing pretty good over here. Now we can check correlations with future returns. So I'm going to merge returns with the original data frame that we used, doing a left index join. So we're joining on the index was the stock ticker. Remember, this is a stock ticker. You can tell because it says index over here, and it's sort of like depreciated by level, right? So it would be, if this was not an index, if we had an index like 0, 1, 2, 3, then it would be at the level of the fundamental features, but we're using the ticker as the feature. So that's how we're doing the merge. So anything that comes from the returns data frame, that has the same index, and anything that has that index is joined together, right, based on the ticker symbol. So we can see refined composite score, 3-month return is 0.84, the 12-month return is 0.81, 6-month is 0.54, and 1 month is 0.12. So let's plot that on this scatter plot over here. Okay, and we can see over here refined composite score versus 12-month return, and it's pretty tight fit over here between the return and the composite score. But let's go ahead and do a quick regression test just to make sure. We're looking for higher R squared. Higher is better. So I see 0.93, so it's pretty decent in the machine learning world. You want at least 0.7. So 0.7 means 70% accurate. The machine is going to make accurate predictions about 70% of the time. You want at least 70%. If not, you have to go back and pick a different model, or grab more features, or grab a deeper data set, or tune your hyperparameters different, right? There's a bunch of ways to get the R squared up. This is 0.93, so 93% of the time, the model is making accurate predictions into the future. For what we're doing now, that is totally fine. Higher is better. I would like to see 96, 97, 98, but we can live with 0.93 for this demo. So return target, I'm looking at the 1-month return, 3-month, 6, and the 12, and I want to know the R squared and the mean R squared right here. So 0.604 negative for the 1 month, 0.862. So that's pretty decent. This is negative 0.58, and this is 0.93. So the 3-month return is good enough for me. I'm going to go with that. It has 0.86. The 12 is actually a little bit better, but that mimics this one over here. But I think we're fine with that. So let's look at the ability of the model to predict a 3-month return. Or we can do 12, because 12 actually is higher. That's 0.393. 12, predict, 12, 12, Control Enter. And here you have it. So these are all the predictions of 12-month return with 93% accuracy, right? So based on these features that we picked over here, okay, these features right here, we can predict which stocks are going to have the highest and best returns for the year. And remember, that came from the random forest regressor, where we're using these features to predict the 12-month return, right? So it's a combination of returns and fundamental features, and these are the best investments that we can come up with, right? So we should get 63% return, 48%, 47%, and the lower ones would be UNH, negative 35. So probably just pick the top 10, I would say, for diversification purposes. Is that 10? I don't even know. 2, 3, 4, 5, 6, 7, 8, 9, 10. Looks like this Disney would be the cutoff, I think. I think that's 10. And we can avoid overfitting here. We don't want to overfit the model. Overfitting is when the model learns all the noise, but it doesn't abstract or learn how to make predictions onto data that it hasn't seen yet. You don't want to overfit. You don't want to underfit, but we can prevent overfitting by keeping the features set small and high signal, and avoiding multicollinearity inputs that has high correlations between the features, right? So remember, we looked at this view over here, correlations of fundamental factors with returns. So that's a little bit different kind of concept. But we want to avoid high correlations, fundamental features that have high correlations with other fundamental features, right? So you want to drop those out so you don't have multicollinearity. And the model thinks, okay, these features are more important because they have a higher correlation. Then you're going to run into trouble with overfitting and potentially other things too. You want to try to avoid that, right? So that's pretty much it, guys. The last thing I'll say is this is not investment advice. I can't predict for sure with 100% certainty that IBM is going to go up 63% in the next 12 months. Cisco is going to go up 48%, and JP Morgan is going to go up 47%. There's too many influences on the market: geopolitical, the price of oil, wars, even things like the outstanding American U.S. Debt now, which is I think $37 trillion. There's other conditions on the domestic front in this country and other countries internationally that can certainly have an impact on stock prices. So this is not investment advice. All I'm telling you is statistically and mathematically how these principles work, right? So this is how to do ranking of Dow stocks, how to understand finance, both fundamental and technical finance, how to apply statistics, how to apply mathematics to solve these types of problems. It's not investment advice. So if you invest in IBM and it doesn't go up 63%, don't try to sue me, okay? Because I'm not going to go down like that. But I'm just telling you from math, stats, computer science, and finance perspective, this is how it works, okay? So, and there's some data science and machine learning mixed in there too, right? So it's a bunch of different disciplines. So I'm going to wrap it up here. That took about 31 minutes. That's one of the longer videos, although I had one that went over an hour, so I don't want to suck up all your time here. But thanks for sticking with me to the end. Hopefully this was informative and useful for you. Send me comments in the comment section if you want to see more like this. I definitely learned some new tricks putting this together, and hopefully you guys were able to learn a thing or two as well. Okay, so I'm going to save this file. I'll share it with you guys a little bit later today when I post the video, and I'll see you guys in the next video. Talk to you soon. Bye.